Worries about the stability of the banking system have spread from the US to Europe. Shares in Credit Suisse fell to a record low after its biggest shareholder, Saudi National Bank, ruled out a new cash infusion. The lender has appealed to the Swiss National Bank for a public show of support. Concerns have been growing about the bank's liquidity on both sides of the Atlantic following the collapse of Silicon Valley Bank in the US a week ago. Now, for more on this, I'm joined by Octavio Marenzi. He's CEO of consultancy OPMS. Mr. Marenzi, Credit Suisse has asked Switzerland's National Bank for a statement of support, confirming it is financially healthy. Do you expect it will have to provide more than just reassurance, financial support maybe?
Oh, I do expect they're going to have to actually put some money on the table, that simply making these pronouncements is not going to be enough. I mean, Credit Suisse is under severe attack. People are pulling out money out of Credit Suisse at a furious rate, and Credit Suisse is simply not going to be able to pay those depositors. So someone's going to have to close that gap, and it looks like the Swiss National Bank is going to have to step in the fray and actually put some cash on the table rather than simply having pronouncements about moral support for Credit Suisse.
What would the impact of such a bailout be on the European market if a Swiss bank out of all countries would have to be bailed out?
Well, I think for the Swiss financial market centre, it's going to be an absolute catastrophe, and I think it has been already. So people have put their money into Switzerland in large amounts in the private banking and wealth management spaces and asset management, in large part because Switzerland has this idea of stability and conservative investment of your assets and capital preservation. And that's the kind of clients that Swiss banks have attracted. That's all now put into question with Credit Suisse. Credit Suisse has done incalculable damage to Switzerland's reputation as a financial centre. And I think the Swiss National Bank and the Swiss government are fully aware of that and want to make sure that this doesn't go any further.
Now, this is all happening, of course, in the context of two bank collapses that we've seen happening in the US this past week. And how far is this related to what happened to SVB, for example?
Well, I don't think there's any direct connection between Credit Suisse and SVB. I don't think Credit Suisse had a big exposure to Silicon Valley Bank at all. I don't think the Swiss bank had large deposits with SVB. So it's not a direct connection. But I think what's happening overall is that we're seeing an environment where we've had very, very low interest rates for a very extended period of time. And that's true in the US and it's true in Europe as well. In Switzerland, a bit less. The SNB is a bit more careful in terms of its management of the Swiss currency. But overall, we've seen very, very low interest rates for a long time. And now suddenly we've seen interest rates rise very, very quickly, particularly in the US. And that is going to break some things. That's going to break some banks who are very dependent on interest rates. It's a very core part of their production process. And as you see big changes in that, some banks are not going to be able to keep up. Compounded with that, I think Credit Suisse has done some whole bunch of damage to itself outside of anything that SVB has done, or anything related to SVB. So there's been some monumental missteps at Credit Suisse in terms of risk management, in terms of investments, and that's coming back to haunt the bank now.
You mentioned the interest rate aspect in the story here. Now, the ECB is expected to increase interest rates again tomorrow. Analysts expect 0.5 percentage point increase. Do you think that today's events might factor into the ECB's considerations for tomorrow?
Definitely. I don't think the ECB wants to give the impression that they're panicking and responding to the latest news and by the minute making decisions about where to put interest rates. So I think they want to convey a sort of a sense of greater stability that and thought about how they're going to approach interest rates. That being said, there's going to be tremendous pressure on them now, on the ECB and on the Fed, who are both making decisions this week about interest rates, to not continue with these big increases in interest rates, because there has to be some losses involved in that. Basically, anyone who's sitting on bonds, a bond portfolio, or a loan portfolio like banks are, is going to have to take losses as a result of these increases. So the banking industry is screaming out for the central banks not to continue with these increases. The central banks, on the other hand, have to still fight inflation. And the only way they can do that is by continuing to increase interest rates. So the central banks, the ECB and the Fed included, are in a very, very difficult bind right now.
Difficult times for central banks. Thank you, Octavio Marenzi. Now, let's get the latest from Wall Street on these developments. Teddy Ostrow joins me from New York. Teddy, have there been repercussions from the banking sell-off in Europe and the US?
Well, Credit Suisse is a global financial institution, so it's of greater consequence, right, than Silicon Valley Bank, than Signature Bank, which we did see fail this week and cause broader turmoil in the markets here in the United States. Now, the pronouncement by the Swiss National Bank to support Credit Suisse is going to pare some losses. However, we have seen some damage here in the United States. The S&P has dropped 0.7%. Now, really, the banks are the ones that have got hit the hardest. Goldman, Citigroup sliding, regional banks certainly sliding. But what we're looking at is investors panicking, looking around at the financial sector, at SVB, at Signature Bank, at Credit Suisse, and saying this is incredibly unstable. We're pulling out their money and trying to find investments that will pare their losses.
Now, we were just speaking about the difficult situation that central banks find themselves in right now, the ECB especially, because of the interest rate hike tomorrow. How might the Fed react to this volatile economy?
Well, the Fed has two objectives, right? It's to ensure financial stability in the economy and to tame inflation. Now, the latter of which it has been doing from unprecedented rate hikes here in the United States, and it does appear to be bringing down inflation. However, it is causing some financial instability. We can certainly say it contributed to the failure of Silicon Valley Bank and subsequently Signature Bank. There are also some issues there about the Fed supervisory issues. But with inflation, right, we have seen inflation cooling here in the United States. The Fed isn't fully happy with the pace, which is why there were expectations that they would continue to hike rates. However, now with the financial instability we're seeing, there are bets that the Fed is going to do a low hike or a no hike after their meeting next week.
So all eyes on central banks. Thank you very much, Teddy Ostrow.